Hey, good morning, everyone. Let's just take a minute or so to let other folks join in. All right, good morning, everyone, and welcome to Decipher with Deserve. Today is Saturday, the 20th of December. I am Kushal Karkare. I am part of the investment team at Deserve, where I look into portfolio analytics and market insights. Thank you very much for joining us here on a weekend. If you've looked at a news app this week, you've seen the headlines. The Indian rupee is at a historic low, touching over 91 against the USD just a few days ago. For many, the 90 level was a major psychological barrier. And for many investors, this immediately triggers discomfort. Is this a sign of macro stress? Is capital leaving India? Should portfolios be repositioned? Today's session is about separating the scary picture from the complete picture. And more importantly, discussing what investors should actually do and not just react emotionally. To help us navigate all this, we have with us today Prateek Bagaria. Prateek is the principal officer for our PMS business, overseeing how portfolios are constructed, how risk is managed, and how investors can stay disciplined and long term focused through all phases of the market. He brings with him over 20 years of market experience and deep wealth management expertise. Good morning and welcome, Prateek.
Good morning, Kushal. Good morning to everybody on the call who've taken out time on a weekend to join for this.
So Pratik, the
Thanks so much.
rupee crossing 90 has grabbed attention everywhere. Before we get into the charts and drivers and all the other aspects, should investors be worried or is this more noise than signal?
On a lighter note, I don't know investors, but if you are traveling abroad, you should be worried, or at least your expenses would have gone up. Uh, One time of meal is what you will have to sacrifice or pay up more to compensate for this 5% fall that we have seen. So just presenting the scary picture first, what we will see or we have been seeing in media for some time is that rupee has been the worst performing currency in Asia, all the Asian countries. So yeah, that's the scary picture that we have in front of us right now. But there is more to it, so we have time today. We should discuss about that.
Got it. Folks, just a call out before we get into the nuances. If and when during the presentation, if you have any questions, please feel free to leave them in the chat and we'll address them towards the end. So, Prateek, let's start with this slide, which perfectly captures investor sentiment right now.
Yeah.
Like I mentioned, the scary picture before the complete picture. Why do currencies move? Currency moves often look far more alarming in isolation than they actually look in a macro context.
So we are constantly competing against other markets for trade, for capital, etc. And that's where we any kind of uh, loss on the currency side is generally seen as a negative. But that said, it should not come as a surprise at all that uh, the currency of an emerging market like India depreciates gradually against the dollar over a long period of time.
Got it. So why do round numbers like 80 or 90 matter so much psychologically, and how would you put it in context of global currencies?
We are hardwired that way, right? Any kind of round numbers, any asset class, not just currency. Let's say a silver crossing 2 lakh will uh, uh, raise headlines. It will catch attention of people. Rupee crossing 90, maybe 100 a few years down the line will again catch some sort of attention of people. It is about the round numbers. Uh, in fact, traders use that to their advantage to trade some securities. Uh, but yeah, it's more like a discussion point uh, rather than anything else, because 90.1 does not matter too much.
Got it. So we've seen things like this before when the Nifty crossed 20,000 or when gold crossed 70,000.
Absolutely.
The
Correct.
number itself became the story, even though
Correct.
fundamentals didn't suddenly change overnight.
Yeah.
Do you think this is exactly like that, or is there something deeper driving this?
There will be some component of that round figure, right? But maybe the story will be bigger when it reaches 100. But what matters, that will it's a good talking point. But as an investor, it doesn't give you any edge to invest or any extra insights to invest better. We'll have to dig a little deeper. Yeah, this chart in front of us is a pretty short-term chart, right? Year to date,
Right.
we are the worst performing currency in the Asian countries. Okay, that's one way to look at it. But let's say had Sri Lanka been 1 point higher or depreciated 1 point lower, we would not have been the worst performing. We would have second worst. So it's not a worst performing by a big margin, right? It's just about the worst performing and not a very big outlier per se.
So, I mean, without getting into too much detail, I'm sure a lot of the viewers have questions on this, wherein us, Sri Lanka, Vietnam, some of the key manufacturing destinations have depreciated. On the
Yeah.
other front, we're seeing China, Taiwan, even some not usual names like Malaysia or Thailand right up there. Is there something there that we should be looking at?
What needs to be seen is how did the currencies performed the previous year? What are the components of its forex reserves? Is it more heavy on gold? What are the tariffs and what is the export percentage to US that these countries are having? So it won't be one factor. It will be a multitude of factors. Possibly it could be just some of the currencies bouncing back from lows that they made previously.
Got it. So, from an economic standpoint, what actually matters more than the absolute level of the rupee?
Uh, For us, this what matters for the rupee is that it uh, it's not an at an alarming level, right? So if you see the depreciation rate for the last 2022 calendar years, it is 3.1% on an average, right? That means on an average, each of the calendar years, we've seen 3.1% depreciation. In fact, in the chart that we have in front of us, out of the last 22 calendar years, 16 years, the rupee has seen depreciation. In current calendar year, we are looking at a 5% depreciation. But that is again not an outlier. We've seen worst in 2022, 2018, 2013, 11, 7, sorry, 8. We've seen more than 10% depreciation in a single year. In some cases, more than 15% depreciation in a single year. Uh, and the appreciations have been far and few, right? Out of the 22 years, we've just seen 6 years where the rupee actually appreciated or strengthened against the dollar. So, from an economic standpoint, this is completely normal. There is nothing new that is happening. The average rate that the rupee depreciates against dollars is 3.1, 3.2, and we are at 5% this year. So, yeah, as you said, that it's more about the 90 rupee psychological mark getting crossed rather than uh, a- any economic distress.
Got it. Absolutely. Like if you recall also, and what we can see here in 2022, there was a 10% depreciation. We
Yeah,
didn't quite hear so much noise about it as we are doing now since it's touched those 90-91 barriers.
right. Not
Is
far
there
back, right? Just 3 years.
Yeah, exactly.
Hmm.
So, I mean, if we zoom out over the decades and break this down structurally, what are the reasons that the rupee tends to depreciate against the dollar?
So, Kushal, we can break this into two, right? You have a structural part of rupee, why it depreciates, and there will be some short-term drivers that lead to depreciation in the rupee more tactically. The structural reason for rupee to depreciate against the dollar is simply the fact that we print more rupees compared to the dollars, right? So you have more supply of rupee if you are printing more rupees vis-a-vis the dollars. By definition or by standard or economic theories, whatever has more supply will go down in value, whatever has less of supply goes up in value. Now, here in the chart towards our left, we are looking at the money supply of India and money supply of US. The red one, the red line is the money supply of India, and the blue line is the money supply M1 for US. Ideally, we should have had M0, but okay, let's look at M1 since we have this data here. The M1 for India grew at 12.2% CAGR for the last 20 years, whereas the M1 for US grew at 8.9% CAGR for the last 20 years. The difference between them, if you note, is around 3.3, 3.4% if we look at the last decimal places. Now, that is exactly what is reflected in the uh, rupee also. So, we started rupee at around 44, 45 20 years back, and right now we are at around 90, which is 3.5% depreciation every year, CAGR, for the last 20 years. So this differential of more printing money faster than the US, that reflects in the value of the rupee vis-a-vis the US dollar over the long term.
Got it. Pratik, if you could also maybe touch upon a little about the M1 for the uninitiated, what is M1 and how does it differ from, as you mentioned, M0?
So let's say M0 will be basically the currencies that you have printed, the reserves that are being held by the banks. That will be like what we call as narrow money. But if you add something like deposits and saving accounts to that, that will comprise of your M1. Uh,
Got it. So what you're saying, this is a good indicator of the overall liquidity in let's say, a country's economic system.
how much money or at what rate the money supply increases, how much printing of money is happening in a current country. This is a fair enough indicator. M0 would have been better, but this is also okay for the purpose that we are looking at.
Got it. So other than just money supply, are there other factors like maybe inflation differentials, productivity and income convergence, stuff like that that is also furthering this rupee slide?
Those are mostly domestic factors, but where the rupee dollar equation, because income will be pretty much a domestic issue, right? Where the rupee dollar equation will come into play is in the foreign trade or wherever we are interacting with the other countries. So your balance of payments, etc., that will have more say in the rupee dollar value over the short term.
So, I mean, that's the long-term story. You mentioned the globetrotters and also investors alike. They feel pain in the short term.
Yeah,
So the short-term forces that are play right now that have accelerated this sudden move.
yeah. So in the short term, if you see the foreign portfolio investments for 30th September 2025 25 towards your bottom right, that is negative $21 billion. That is causing the stress for the rupee in the short term. How it is doing that, I'll just like to touch upon that. Let's say in September 2020, what are the uses of forex reserves for us, and where do we get those? Where do we spend our dollars, and where do we get our dollars? Right? We spend our dollars on purchasing goods, right? So in September 2020, or let's look at September 25, we spent $295 billion roughly in purchasing goods. Now, this goods, the biggest component of this good would be import of oil. And in some years, when we are very excited, it would also be the import of gold. Yeah. And that gold could not need not be just for jewelry. It could pretty much be for ETFs and other investment related demands also. Right. So we purchased goods worth $295 billion. Uh, so that is your dollar going out. And then you have $53 billion being paid out as interest, dividend, or any other primary income that goes out from India.
Got it.
So that is roughly $350 billion. Now, how do we pay these $350 billion? Where do we get those $350 billion? $200 billion we got from services. Now, services could have multiple things like travel, tourism, finance, etc. But the biggest component would be software exports. So $203 billion from our services exports and $132 billion from our remittances. So people who are staying abroad, them sending money back to India, that comprises around $132 billion. But that put together is just $330 billion. We are still $20 billion short. And let's say we had another $5 billion in FDI, that is 237, let's say $240 billion. But we are still $10 billion short. And on top of that, foreign portfolio investors took away $21 billion. Now that leaves us with $35 billion of gap. We still need to pay for covering our uh, 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 goods imports, for paying out the FPIs, etc. That comes from your reserve assets. So forex reserves, we need to basically take out the $35 billion to make good this payment.
Got it. So we can
Whenever
see a
this
fair amount of variance here in the, let's say, your use of forex, your goods, or which comprise of oil and gold, as well
Yeah.
as your reserve assets. But the services, which are the software exports, seem largely stable. Is that a good sign, and should we be happy about something like that?
Yes, definitely. So we will have a lot of noise around software exports slowing down, and that's the reason currency being impacted. But that is not entirely true, right? Because last year, by September 24, we had $172 billion coming from services exports. This year, we have $203 billion. That's a very healthy growth. Even on the remittances side, we had $116 billion of remittances last year compared to this year $132 billion. So that are not your problem areas, right? The problem area is the foreign portfolio investments, which was positive 44 billion last year and negative $21 billion this year. So that $61 billion change is what creates a short term supply of rupee and demand of for dollars from our balance of payment side.
So is it fair to say that this short-term imbalance causes this again short-term stress that we've been seeing?
Yes, look, it's not a structural thing like what we discussed before, right? The money supply is pretty structural. You can see that continuously, with little variance, we have kept on printing money at a rate higher than what US prints. But these are more short-lived. For example, in 2022, in our chart itself. Here again, we saw that we had $29 billion of FPI outflows, right? And that was made good by using $41 billion out of our forex reserves. right? But rest of all the years we've contributed every time the forex as the FPI and FDI were positive, increased our forex reserves. So so basically this is more like a short-term fluctuation that occurs. And to mitigate this short-term fluctuation, our forex reserves come into play.
Got it. So, coming to the next and burning question, what should investors actually do when something like this happens?
Yeah,
Chart on our screen here often gets overlooked when panic sets in. We still
yeah.
have a healthy amount of import cover. Now, before you get into the nuances of it, if you could quickly tell us what import cover actually means.
So basically, your government owns 687 billion dollars of forex reserves. That's that much in reserves. Those dollars can be used to import uh, goods and services from abroad uh, without taking any or without getting any fresh dollars in the country. Now, with $687 billion, we can import 11 months worth of goods and services without having any fresh inflow of dollars, which is a theoretical scenario, right? It's not
Right.
going to happen that we do not have any forex inflow for 11 months. But let's say if that were the case, we would still sustain uh, importing using our dollars for 11 good months. Just to put a benchmark against this, we had less than 1 month of import cover pre-liberalization during 91-92 period. So yeah, and also as we discussed in the previous slide, right, that your forex reserve is something that acts as a buffer to manage your deficit or surplus in your accounts. So we a $35 billion going out of a $700 billion reserve on account of FPI not coming in a particular year. It's not a very significant move, right? So that ways the forex reserve of $687 billion, let's call it $700 billion, um, is a very good buffer that we have as of now, and there is absolutely no reason to panic or look at this as a distress situation.
So, I mean, to just summarize and condense this for the viewers, are you saying that India's foreign exchange reserve position is a good barometer in assessing the currency risk that we face?
Yes. So had we absolutely, because that is your buffer, right? If you do not have any reserves left, the only option for you would be to get dollars desperately anyhow, or suck out the liquidity. So yeah, this is a good barometer to say that you have enough of buffer to go on without with some more FPI outflows, let's say, if that the case be.
Understood. So we've seen in the previous charts years when the rupee has depreciated sharper than we've seen in this calendar year. In
Yeah.
past currency stress episodes, let's say 2013, for example, what was missing that we clearly have today?
Uh, in terms of forex reserves growing.
Yeah, in terms of forex reserves and a general buffer against all of this noise and volatility.
So actually, even then the situation was not too bad, right? We had on this side, at least for forex reserves, as this chart shows, we've been pretty stable. It's the forex reserve has been pretty much a one-way ride, uh, growing all the way from $50 billion to $700 billion. We saw that our balance of payments also that is also not very jerky, right? The goods imports remain stable, the services exports remain stable, remittances are pretty stable. So no real surprises or no major change as such over the last 5-10 years. It's pretty much business as usual, you can say.
Got it. So, this what we have on the slide here appears to have a fascinating relationship. Why do we
Yeah.
often see foreign flows return after periods of sharp currency depreciation?
So our foreign investors, when they invest, they have to look at their returns not in rupees like we do. They need to look at their returns in dollar terms. Uh, Generally, we've seen that any calendar year when we have seen more than average depreciation. So the average depreciation I'm assuming to be 3.1%. And if we see more than 3.1% depreciation in a particular year, the next year we have had foreign investment invariably. We have had FPI inflows uh, without any exceptions. So 2005, 8, 11, 13, 15, 18, 22, multiple such instances where the rupee depreciation was faster than the average, and next year you had a good FII inflow. In fact, towards the table towards your right, if you look at the performance of if you break down the performance of Indian rupee into, let's say, below average and above average, every time you had a below average performance of rupee, the next year the average FII inflow was 92,000 crores. Whereas if you had above average performance of rupee, next year FII inflow was 15,000 crores. So right now we are at below average. We are closing this calendar year. Most likely it will be below 3.1%, with around 10 days to go. So next year, hopefully we see good amount of FPIs, and that picture where we are using up our forex reserves to uh, fund our imports, etc. That
So,
should.
yeah. So, I mean, even further to your point, we've seen up till this date in this calendar year, we've seen about a lakh and a half crore outflows via the FIIs. Is
Correct.
that also something that we're looking will mean revert next year when we've seen periods when there's no two consecutive years when there's heavy outflows?
Absolutely. Plus the valuations that they exited at and the valuations that the market currently offers, that has also changed, right? Because the earnings are back. Uh, Generally, the prices look a little bit more attractive compared to what they were looking in 2024, the last period when they have taken out money. Plus, you have some sort of triggers going forward, which you should look out for in terms of tariff. Crude, thankfully, is stable, so that should not spring up any surprises. Um, yeah, most of the components are pretty stable except for the FPI, so which seems to be um, looking good for the next year.
Got it. So for FIS, currency weakness often marks the point where valuations, earnings, and foreign exchange all start aligning favorably. Does a
Yeah,
weaker currency actually improve expected equity returns for global investors?
it should, right? Because let's say if the depreciation has happened in advance, you are looking at dollar returns. um, at least it should give you some room for error, if not higher expected returns. It should give you some room for error to invest in Indian equities.
Got it. So let's bring all of this back to our portfolios, investor portfolios, and generally what we should do. How
Yeah.
should investors think about gold, not emotionally, but structurally in the context of currency risk?
Uh, so let's take this case that we have in front of us, right? Let's see if there are two guys, blue guy and the red guy. Both of them had $1,000, sorry, 1,000 rupees at the start of the period. In 2005, both of them had 1,000 rupees. The red guy decided to hold on to 1,000 rupees, and the blue guy decided to hold on to 940 rupees, and 60 rupees he invested in gold. In 2005, both of them could have bought $22 with that much money. But by the end of 2000, or by February, March 2025, the red guy can now buy only $12, roughly 11, $12. But the blue guy can still afford to buy $22 because of the position in gold. So by having just 6.5% allocation in gold, what the blue guy did was hedged his exposure, uh, currency exposure, and the purchasing power is maintained in terms of dollars.
Got it. So, I mean, there'll be questions across the board. Why does gold behave differently in INR terms versus USD terms? If you could just break down the factors that drive that beyond your inflation and other factors.
Um, so in INR terms and USD terms, the difference will be that the currency is the additional factor uh, between the two. So gold returns plus the INR return will make the gold return in INR terms and in USD terms.
Got it. So again, now bringing this back into the context of deserve, we ourselves have a precious metal strategy.
Yes.
How have we factored this into that? Is there something that we do additionally there that would allow us to not just hedge our currency, but also get us an alpha over and above that?
So what we are trying is to have a base allocation in gold. Our default position is to have gold. But in case the gold to silver ratio goes above certain percent, we can have up to 50% allocation in silver as well. But that is purely a tactical or a trading position, and we cut that once we have enough profits or once the gold to silver ratio reverts back to the mean.
Got it. So what you're saying is that the primary objective is to hedge your currency through a gold allocation, and in times of let's say periods when silver is undervalued relative to gold, we're trying to generate an alpha via that allocation.
Yes. So we've seen that having a 10% allocation in these times, along with your equity debt portfolio, that can substantially, like how we see in this graph itself, right? It can substantially cut down your currency risk per se.
Got it. So, folks, we hope this was insightful and helpful. We'd more than welcome any feedback that you have, good, bad, ugly, average. We're looking to constantly improve and deliver better content to you. So, please do leave feedback. And with that, I'd like to get into any questions that you may have. So, Pratik, we have a few questions on the FPIs, FDIs. They've remained net negative despite valuation correction and an increase in earnings and the
Yeah.
rupee depreciation. So, I know you touched upon the larger aspects of it. If you could just dive a little deeper and give us a few more insights.
So yeah, one of the questions that I see is around FPI, FDI. Is that please clarify why FDI, FPI remains negative despite valuation correction and depreciation of rupees. Uh, So the FPI, FDI, FDI is pretty much muted. Not much action happening there. It's not negative. It's slightly positive. FPI is the cause of concern this year, at least. We've seen a good amount of redemptions by the FPIs. The primary reason for that is one is that a little bit expensive last year, and uh, uh, the intent of is right now, or the trade playing out globally is the AI trade, and that's where most of the FPI money continues to flow. So you are essentially competing against those bets, because in India you do not have any pure play AI bets for FPIs to come in and bet on those. So basically, India is as HSBC also called in one of its reports, that India is a contra bet against AI for FPIs. So yeah, your AI stocks doing well and Indian valuations being high, plus the rupee getting depreciated. Those are the two, three triggers that are leading FIIs to move out of India.
Got it. Got it. So, we also have questions on our other strategies as well and the deployment plan, not just in terms of gold, but in also in terms of equity and fixed income. Now, recently we have revised our stance on equity deployment to 100% lump sum. Does
Yeah.
any of this have any correlation with that, and how do the other pieces interlink?
No, in case this causes, this should not cause any jitters for an equity investor right now, right? These are the things which are behind us now. Rupee had to depreciate, FIIs had to sell. These are the things behind us now. As we discussed, the next year looks promising both in terms of valuations and in terms of FII flows. We should see positive surprises going forward in the next year. On top of that, over the next 12 months, let's say if we are able to arrive at an agreement, a free trade agreement or a trade agreement with US, that should only boost the picture because most of the negatives from that front are now priced in.
Got it. So we've also got a bunch of questions on gold and silver. You touched upon how we're taking tactical allocations to silver to generate alpha. Can you just maybe touch upon where we are right now, what that ratio is at? Should we continue to look at silver as a tactical play, or has that time passed?
So as of now, the ratio has come down significantly. Silver has become a lot more expensive relative to gold. The ratio had touched crossed 100 actually, and now it is hovering around 70. So and the average is around 60-65. As a pure play tactical bet, you would not want to get into silver right now. Looks a little overheated. Let's say once the ratio goes up, that means once gold moves up further, but the silver doesn't, or silver comes down, gold doesn't. That's when you should add some silver. But right now, at least we think it's not the best time to add silver.
So we've also been getting certain rumblings about, uh, let's say, alleged silver stockpiles dwindling and there not being enough supply.
Yeah.
Is that also something that is a cause for concern?
That will be a more fundamental way to look at silver, which ideally we it's obviously a big positive for silver prices, but given the way the prices have run up from 90,000, not far back, right? In June around you had 90,000, and within 6 months you have prices doubling much fast. So a move which is much faster than the gold prices. That is a little concerning, and uh, that may outweigh some of the positives that silver has as a commodity.
Got it. So, in terms of the investors who have SIPs towards precious metals like gold and silver,
Yeah,
and also the ones who are looking to invest in a lump sum manner,
yeah.
what is the strategy here? Should they continue with the SIPs? Should they keep adding gold? How should we look at it?
Yeah, so I'm assuming that people are also having SIPs in equity. Having dividing your SIP between equity and silver or precious metals, that's a good strategy because you gain exposure in both simultaneously and you get a gradual entry instead of deploying everything lump sum. So that is, yeah, pretty much what we are also suggesting, that 10% of your portfolio should go into silver, 90% is your allocation between equity and debt, depending upon your risk appetite. But yeah, whether you are deploying lump sum or through SIP, uh, uh, precious metals is a must, whatever way you do it.
So you mentioned 10% of your portfolio should be in these precious metals. What about the investors who maybe through their allocations in the past and the recent rally, their allocation has run up to, let's say, a 15-20%? What would
Correct.
you recommend to someone like that?
Absolutely. No, nice question, Kusal. There you should cut down your exposure and you should bet that money on your debt and equity portfolio on the financial assets. It's very important to keep rebalancing your portfolio. You don't want underexposure or overexposure in any uh, of the asset classes that you should be owning.
Got it. Got it. Just bringing it back to the crux of our presentation today, in terms of the rupee depreciation, how we've depreciated over 5% this calendar year. I know it's not a very easy question to answer, but do we see this rupee depreciating again at the same pace, or is there going to be some stoppage in this slide?
So as we discussed, Kushal, right, the average pace of rupee depreciating against the dollar is 3.5%. That will continue. In some years, it will be, let's say, 5%. Some years, it will be 2% or 1%. In some extreme years, maybe wider. But it will hover around the same. And in the long term, we should see a similar depreciation against the dollar, unless until something breaks, right? So those caveats are in place.
Got it. We've also been hearing from investors on certain, as you would call them, exotic investments, like maybe investments in other metals like platinum, copper, or even a newer asset class like a cryptocurrency. How do we approach something like that?
Uh, our preference has been to be exposed to securities and asset classes which are governed by SEBI. Some of these asset classes, even gold to an extent, we have seen that we had digital gold or e-gold. Those things, in our experience, do not end up well at times. It's not a risk worthy of taking as per our understanding.
Got it. So, with the recent rupee depreciation having distorted INR returns, why should someone having access to, let's say, LRS invest in India when the S&P and Nasdaq have given superior returns?
So we are looking at the past in that case, right? If we keep on chasing returns, we will end up buying things at top and selling them at the bottom, right? So uh, from here on, 2026, how does the outlook for S&P, Nasdaq, or Nifty 50 look like? That's what needs to be answered. Will the because Nasdaq, S&P both have become relatively much more expensive compared to the Indian markets, right? Would you still want to bet in the global markets, or would you rather look at Indian equities? Is the question that you need to ask yourself.
Got it. So, a final couple of questions, bringing it back to the equity side of things.
Yeah.
In terms of mid and small caps in the Indian market this year, we've seen them largely flat or in the red territory. Do we see these valuations having normalized, and what is the outlook for the next couple of years?
Uh, Separate outlook on both mid and small. Mid has already started showing signs of recovery. The growth is good, and once the growth is good, obviously the valuations start making sense. Same, unfortunately, has not been the case for small cap so far. Maybe 3 years, 6 months during the over the next year, we will see small cap companies also doing well. But as of now, we would be more positive on mid caps and large caps also compared to the small caps.
Got it. Got it. And finally, for someone who is looking to invest in a gold or silver to hedge their currency, what is the best approach, and how would you distinguish between, let's say, an ETF, mutual fund, and now the now discontinued SGBs that were on offer?
Yeah, SGBs people made a killing, right? Gold returns tax free plus a 2.5% dividend coming from government of India. Unfortunately got discontinued. But yeah, the gold mutual funds, ETFs, that's the best option that we have right now. It brings in a lot of tax advantage with it because it gets treated as equity taxation after 2 years. The gold index funds, the ETFs get equity taxation sooner after 1 year. So yeah, tax advantage is there. The cost of managing is also low. Plus, yeah, there's no unlike physical gold, there is no stress of security or protecting that asset. Plus, it's regulated by SEBI, so you are always comfortable in that sense.
Got it. So in terms of the ETFs, very recently we saw that a silver ETF ran up nearly at a 10% premium to the actual silver price.
Yeah.
Is that a phenomenon we also see in our mutual funds, or is this peculiar to an ETF?
So the reason for that was that the demand in the spot market was much higher than the demand in future markets, and that's why it went into a premium. Uh, this when this happens, we call it backwardation. When otherwise it's contango. It, it happens. It's not very frequent, but it's a rare phenomena. You can say it does happen. It can happen again. Yes, possibly, but that is not something that we are betting on, right? A 2-3% premium over the futures. Ideally, you should be having a long-term view on these things, and these short-term blips are a part of the journey.
Got it, got it. Thanks, Pratik. That was very insightful. I believe we must have answered a lot of burning questions. Before we take your leave, any final thoughts and something you'd like to share with us?
No, so just to sum up, the rupee dollar situation, we are down 5% YTD on INR USD. And as Shah Rukh Khan would put it, that ऐसे बड़े बड़े देशों में छोटी छोटी बातें होती रहती है. Nothing alarming. We should not be very concerned. Stay the course. Deploy 100% in equity. You should have faith in equity right now, because this is the this these are the times when you get the risk premium, right? So uh, and keep sight of the positive triggers going forward, like what's happening on the tariffs, crude oil, and the FIIs coming back to the Indian markets.
Got it. Got it. Super. Thanks, Pratik. And thank you, folks, for taking the time out to join us on a Saturday. We hope you found this session insightful, and we look forward to hosting you very soon again with another session of Decipher with Deserve.
Thanks.
Thank you.